This is the 25th anniversary of the UK Individual Savings Account, or ISA. To celebrate this fact in this video, we'll look at how to become an ISA millionaire, how much you need to invest, how long it would take to become one, and also how does your choice of investments affect the time to go from £0 to £1 million. Today's video is sponsored by Trading 212, a commission-free investment platform. Now, how many ISA millionaires are there in the UK right now? Well, this period of very strong equity returns has meant that actually there are very many of them. In fact, almost 5,000. And if we compare that with the number just 9 years ago, it's increased 11-fold. Now we can start to get a bit of a clue as to how to become an ISA millionaire when we look at the average age of those ISA millionaires, which is currently about 73 years. It has come down a bit recently. Furthermore, although we don't have details on specific portfolios, what we do know is that for the 25 largest ISA holdings in the UK, the average holding is just under £9 million. So not only have many UK investors reached that £1 million mark, many of them have smashed it completely. And while we're talking about ISAs, I can't resist the temptation to talk about why they're so great. And to understand that, you have to understand how taxation is related to ISAs. Now, if you have a pension, your money's paid gross into your pension. That's before you've paid tax. In contrast to that, with an ISA, the money's paid in after you've already paid tax. So you have your gross income before you pay any tax, you pay some tax out of that, and then you get your net income, which you use to spend, and of course make your ISA contribution. Then the money that you put into your ISA can compound over many years, completely tax-free. There's no income tax to pay, there's no capital gains tax to pay, and then you can spend that money, more of it, at a later date. Now, many countries around the world have nothing as generous as a UK individual savings account. So this is something for which we should be grateful. Also, we should make the best possible use of them. Now, there are lots of other great things about ISAs. Firstly, you can put in money into an ISA at any point in your life, even after you retire. You can also take money out of an ISA at any point, so they're very flexible in that sense. They are just tax-free savings accounts. Furthermore, that tax exemption applies forever. And of course, if you're compounding over a very long period of time, the capital gains tax savings can be huge, as we'll see. Also, with the proliferation of investment platforms in the UK, you have very many investment choices within an ISA. There are thousands of funds to choose from, also thousands of ETFs in which you can invest, plus single shares or UK government bonds or even corporate bonds. Now, before we go on to talk about how those investors reach their £1 million goal, I'd like to talk about Trading 212's ISA. In fact, today's video is sponsored by Trading 212. I've been using Trading 212 stocks and shares ISA for a few years, and I love the platform. Here's why. Firstly, it charges no account fees or any monthly or annual subscription fees. Secondly, it offers lots of choice for my fund portfolio, which is what I have on Trading 212. Trading 212 offers over 13,000 ETFs and stocks from the UK, US, and Canada and Europe. And finally, it leads the way with new functionality all the time. The product managers and software engineers at Trading 212 are always busy on our behalf. For example, it offers fractional shares, pies, and Autoinvest as features bundled into their ISA. If I had to choose my favorite feature, it would probably be pies, where you can create portfolios within your ISA. I have lots of ideas for my fund portfolio, and pies let me track those ideas and monitor them separately. For example, I've got a UK small cap pie, a copper miner pie, and a European defence stock pie, all within my Trading 212 ISA. If I want to rebalance any of those pies, I can just do it with one click. You can fund your pie using regular investing via direct debit, and that encourages regular saving. You can also reinvest any dividends back into the pie automatically. And if you're scratching your head deciding what to include in your pie, there are lots of popular portfolios and portfolios created by professional fund managers. If you don't like the risk involved in buying stocks, then Trading 212 also offers a cash ISA. This offers a market-leading rate, currently 4.5% as I make this video. Furthermore, Trading 212 charges no account fees whatsoever on their cash ISA. Your interest is earned daily and paid monthly. The cash ISA is also flexible, which means that within a tax year you can withdraw cash and put it back into the account without affecting your ISA allowance. Your money is kept in a segregated account and protected by the Financial Services Compensation Scheme up to a value of £85,000. Now, if you as a pension craft have a special offer from Trading 212, you can claim free fractional shares worth up to £100. Just open an account, verify it, fund it, and then use my name as the promo code, which is RAMIN, RAMIN, and you'll find a link to that offer in the description below. So now let's work out how those ISA millionaires did it. Their achievement is all the more remarkable because the allowance for ISAs has been creeping up gradually over time. And in fact, if we go back to the year 1999, which is when they were first introduced, the allowance was only £7,000 and it was frozen there for several years. Now, in theory, you'd expect that the ISA allowance would increase with inflation. Otherwise, in real terms, its value would fall. However, what we actually see is that there are many years where it doesn't get increased. So assuming that these ISA millionaires have used their full ISA allowance going all the way back to 1999, what return would they have to have had to reach $1 million? Well, it's not a huge amount, it's 9.8%, a shade under 10%. And remember, for stocks, that is the average long-term return, at least in the US. So part of the recipe for success is investing in stocks because of their higher return. Of course, you have to bear the volatility, but eventually it'll be worthwhile. And eventually is the key word there. I think the other half of the success recipe is sticking with it. Use your allowance every year that you possibly can, max it out if you possibly can, and that way you're more likely to reach this £1 million goal. Now, don't feel disheartened if you're way below £1 million. If we look at the average ISA value in the UK, you can see how it varies with age in this graph. The average market value for people who are 25 to 34, for example, is around £10,000. But here you can see the effects of compounding and regular saving, because note how that black line, which is the average size of the ISA pot, increases very rapidly between the ages of 55 to 64 and 65 and over. Now, of course, you can't save money that you don't have. So as you'd expect, if we look at the size of ISA pots versus the income of people who are saving, you can see a very clear positive relationship there. It's no surprise that people with 150,000 or more in annual income are the ones which have by far the largest pots. Now, because inflation erodes the buying power of your money over time, in the things which follow, I'll be talking about real return. Why does that matter? Well, if you look at the price of a coffee in the UK right now, in London, it's around £5 for a latte. Now, if we assume inflation is 2% per year, if we look over a 2-decade period, you'd expect the price of a latte to increase to about £7.40. If inflation is actually 3.5%, which is closer to its long-term average in the UK, then that latte will cost you £10 in 20 years' time. So when you save, you should always think in real terms, in inflation-adjusted terms. So if you're starting out wanting to be a millionaire today, in 2025, then you probably want to think about £1 million buying power in 2025 pound terms. So applying that to our historic ISA allowance, what happens if we inflation adjust that allowance and express it in terms of the buying power of £1 in 1999? Well, you can see that for that early period when the allowance was frozen at 7,000, the buying power was eroded quite significantly. And in real terms, the ISA allowance was shrinking. Then we started to see above inflation increases in the ISA allowance, and that peaked in about 2017. Since then, since it's been frozen at £20,000 for several years, you can see again, in real terms, the ISA allowance has been plummeting. But to become a millionaire in 1999 pound terms would take longer than it did in nominal terms. Now the average rate of return that you'd have to achieve would be 15.7%, and that would actually be very difficult to achieve with a regular stock portfolio. A global index fund simply wouldn't have cut it. So now let's focus on what matters to you, which is how you can reach a £1 million ISA. Now, over a 20-year period, what you'd expect is that stocks would return something quite close to their long-term average return. And again, we have to think in real terms. So these are returns above inflation. A great source of information about those returns is Dimson Marsh and Staunton. And what I've highlighted here are the average real returns in the US and the UK over this period between 1900 and 2022. For the US, stocks have returned 6.4% above inflation, and for the UK 5.3%. If instead you'd gone for something like a cash ISA, which returns roughly money market rates, then your return would be much lower, about 4% lower per year in fact. The return then would be about 0.4% in the United States in real terms, or 0.9% for the UK. So to reach that £1 million mark, stocks will do a lot more of the heavy lifting for you, and you have to save a lot less to get there than, say, cash ISAs. So now let's make a really conservative assumption, which is that the government does not increase the ISA allowance in line with inflation at all, and they don't increase it ever. We can plug in those average returns for stocks that we saw previously to see how long it'll take to reach £1 million. I've also assumed that you're going to max out your ISA every year, which is no mean feat. Furthermore, I've also assumed that inflation is a fairly high 3.5% because that's the long-term average for the UK. Based on those assumptions, it'll take 19 years to reach £1 million. Now, if you want to reach £1 million in today's buying power, it'll take longer. Now it'll take 25 years. How about if you use a cash ISA to get there? Well, you can probably guess that it's going to take longer because the returns are lower. If we assume a nominal return of 4%, it would actually take 28 years of maxing out your ISA to reach that £1 million mark. And if you want to reach £1 million in today's buying power, that would take 44 years. But the message here is pretty clear, which is if you go for safety, it'll take a lot longer to get there. Now that was pretty disheartening. How about if the government does something sensible, which is to roughly keep the ISA allowance in line with inflation? Well, now it should take less time to reach £1 million because you can invest more. That's assuming that you can invest more, of course. Well, if we have the same inflation assumption and the same return assumptions, now it only takes 17 years to reach £1 million in nominal terms, and that's if you invest in equity. That pushes up to 21 years if you want it in today's buying power. And then if you invest in cash ISAs, it still takes 22 years or 28 years to get there in real terms. Now, I don't want you to think that the only way to get there is to have 100% equity. There are lots of portfolios which historically have actually achieved pretty good returns, but which combine different asset types. And you can backtest that with tools like portfolio charts. Here I've used portfolio charts and something called the weird portfolio, which has 5 investments in fairly weird things. The weird bits are using small caps rather than large caps for your investments. But here you've also got long-term bonds, US REITs and gold making up each of the components of the portfolio in equal amounts. And here I've assumed a constant contribution of 20,000 a year, so we haven't uprated the contributions in line with inflation. And we're looking at how long it takes to reach that £1 million goal. So historically, if we go back to every starting year since 1970, it would have taken between 17 and 23 years to reach that £1 million goal. So roughly in line with the calculations we've done previously. Now that's surprising because we've got quite a bit of bonds in our portfolio plus an asset like gold. So there are multiple ways you can actually reach that goal within this kind of time frame. But what's pretty clear, in summary, is that you have to be patient and you have to max out your savings. There are no shortcuts, and ideally you'd be doing this for a very long period of time and getting reasonable returns over that period of time. Now you may be tempted to go for something like a leverage portfolio or something like cryptocurrency, which is equivalent, and I think the risk there is that you're wiped out completely. So personally, I think the slow and steady approach is much more likely to get you there. Now don't forget our offer from Trading 212. You can claim free fractional shares worth up to £100. Just open an account, verify it, fund it, and use my name as the promo code, RAMIN, RAMIN, and of course there'll be a link to that in the description below. And as always, thank you for listening.